calculating break evens. We kind of went over this a little bit. We just got one slide to get into. My favorite, we got y equals we have the quadratic formula. So secret formula, we got the strike sold, and then you add or subtract the credit received, and then that will be your break even at expiration.
Bro,
so
this is the quadratic formula.
Yeah.
That's so funny. We're
Yeah.
using this.
Yeah,
I guess
no,
my bad.
I literally, this has nothing to
guess.
do with break evens. It was very fitting for the theme.
Oh yeah.
Yeah.
No, yeah. I think you can use a quadratic to find your break even point.
No.
Or I don't remember which formula it is.
Yeah, no, but we can calculate the break evens with this formula right here. Strike sold, add or subtract the credit received, depending on if you're selling the puts or depending on if you're selling the calls. If you're selling the calls, you subtract the credit received. If you're selling the puts, you subtract the credit you received. If you're selling the calls, you add from the credit received. Because if you think about it, the calls are on the upside, puts are on the downside, and our break evens make our margins wider. That means our break even would have to be to the upside on the calls, which means we have to add the credit to find the break even that's a little bit above the strike that we sold. If you think about the puts being on the bottom, and we understand that finding the break even, it's going to make the range wider. So we can understand, okay, we're going to have to subtract from the put side. So it can give us an idea in our head. Oh, we're selling calls. We're going to add the credit receipt to the break evens. We're selling puts. We're going to subtract from the strike that we sold to the break evens, and then we're going to expand a little bit wider and have that nice little range, depending on how much credit you can receive. That's the nice part about volatility expanding, because then you can simply collect a little bit larger of a credit, and the larger credit you receive, the wider break evens you're going to have. So if we typically are collecting, $1.50, let's just say, and we sell the 50 calls, our break even is $51.50. But if premiums are pumped up, they're a little juicier, volatility is expanding, all those kind of things, then maybe we're collecting $2 on that trade this time, and now our break even's at 52 rather than 51.5, and now we have a wider break even. Wider break even is also going to affect the probability of profit on the trade, so you're going to have a higher pop as well at the same time. So that's kind of nice, being able to collect a little bit extra of a credit, give yourself more of a chance, a little bit more room to play with. And then on top of that, when you can go a little bit wider, especially on something like an iron condor, it gives you the opportunity to, if necessary and if conducive to what you're doing in adjusting positions, it gives you the opportunity, whenever you do roll one side of the contracts down, it's still a pretty decent little margin that you have. If you're able to start wide initially, and then you can bring it in as time goes on and collect a little bit more of a credit when you roll those trades. So break even points.
It's like squeezing the rest of the juice out of a lemon.
Yeah, you're right. That's actually a really good way to think about volatility, or extrinsic value, actually. Because as we know, there's two components that make up extrinsic value: volatility and time. So it's almost like the time element is like a dripping faucet. It's continuous, time is constant. So the contracts are always losing value as each day passes, just because time can't stop. So as each second passes, each day passes, we're losing a little bit of time. And then that extrinsic value is just slowly getting sucked out of those contracts. But